Ladies and gentlemen, it's 2 o'clock. We'll start the webinar. Thank you for joining us. Today's webinar is the second in a series of 6. And the subject today, if I can manage to forward the slide, is today's session is on pension sharing, hints and tips. And just before I start, a couple of housekeeping points. Firstly, I'd like to thank even my colleagues Jeremy Jackson and Rob Starling for joining me as facilitators. We found that last time, when the last webinar we ran had a lot of questions, and Rob had quite a high workload to deal with it. So I've got Jeremy and Rob answering questions. If you have questions as we go through this webinar, perhaps you could put them into the chat box, and Rob and Jeremy will answer those as we go along. And if there's anything which is sort of relevant or useful to the whole team, then Rob or Jeremy will interrupt me as I go along. Rob or Jeremy will also be dropping a couple of web links into the chat box as we go through this 40-minute webinar. And at the end of the webinar, I'm going to post a link to a short SurveyMonkey survey. If you would be kind enough to spend a few minutes, apparently it'll only take 2 minutes to complete. It really does help us reflect on the webinars that we're running and improve them for the future ones we're doing. And at the end of the webinar, we will keep it open as some people requested that in the last webinar they had quite a few questions, which if you've got questions you want to ask, we'll keep the webinar open until it, I guess, naturally dies a death, in order for you to answer us to answer your questions. You'll also be sent a copy of these slides and a reminder of the web links that we're giving you, and also a recording of the webinar should you wish to listen to it again or share it with somebody else. And Rob has reminded me that just in case these Zoom webinars get hijacked by anyone or anything unsavory, we will stop the recording and instantaneously, I hope, send you a new web link, webinar link. So let's hope that doesn't happen. So anyway, the topic of today's webinar will kick off on hints and tips.
Mark, just a super quick one, Mark. One of the attendees suggested that they couldn't mute themselves. So I don't know if there's anything that you can do to mute everybody, or alternatively ask everybody to mute, but just in case.
Well, look, I can't find it immediately. I would have thought you can mute yourself. That's probably one step. Just looking at the screen, I'm going to go with the fact that we can't. You'll have to mute yourself, I think.
I think it's probably been set up on the basis that everybody is muted already, Mark. So
well done. Thank you, Jeremy. Anyway, we're going. The agenda is just a couple of slides on BlueSKY, who we are and what we do, for those people who are perhaps new to the webinars. From the last webinar, we had a couple of questions on terminology. So I've got a quick slide on some of the terminology that I'll be using and explaining that. And then we head off into the hints and tips, which I'm trying to, where possible, link to a case study. So I have one case study that my endeavor is to follow through these 40 minutes with one case study to help illustrate the points I'm trying to make. So the BlueSKY team, some of you will have seen this before. The 4 pension on divorce experts, as referred to by PAG, are in the are shown there in the bottom. Rob, Jeremy, Mark, Mike, and myself. A lot of you will know that we are chartered financial planners. We're not actuaries. However, we have been producing pension sharing reports since the year 2000, when, of course, the legislation changed. And as you'll see by the logos at the bottom of the screen, Rob and I are specialists, accredited specialists with resolution, which means we can act as financial neutrals. Mike and Jeremy are going through the accreditation process in due course. Areas where a financial planner can help, which I guess you would pick up as we go through this session, but the first point we'll be making a lot in this webinar is the nature of the work we do does lend itself to case discussion before we accept instructions, and picking up the phone and discussing a case with us is always, well, invariably very helpful in helping you generate your letter of instruction and perhaps helping in to prepare a case to ensure that the objectives, etc., are understood. We act as single joint experts and also will do single instructions as what we call shadow expert work. You'll know that we do pension sharing reports. Meetings are always welcomed with solicitors and clients or mediators. We find the work we do in meetings generally can have some really great outcomes in leveling understanding and education and helping the process to a conclusion. I would imagine that about 20% of the work we do is deciphering other people's pension sharing reports. And I think we'll all accept that sometimes actuarial reports can be quite deep. And one of the roles we do as financial planners is perhaps to put that in some context with you and your clients. And finally, we'll be talking today about implementation and financial planning work once you and your clients have come to an agreement. The terminology I'm going to run through is someone wanted to know what the PAG report was. Well, PAG actually is the Pensions Advisory Group. There's quite a lot of history to how this report was crafted and produced, but what we're referring to when we talk about the PAG report is in 2017, a body of financial planners, actuaries, judges, mediators produced this guide to how pensions on divorce should be treated. It was really the first stick in the sand of how pensions on divorce should be treated and approached, and many of you will probably be already aware that judges are already referring to this as a guiding light in our world. I mentioned before about shadow experts. A shadow expert is a singly instructed expert. So if you don't want or have already got a single joint expert report, we can assist to help you and your client on a single basis work their way through a suitable settlement and agreement. As part of my case study, I'm going to be talking about an AVC, which is an additional voluntary contribution pension scheme. These are pension schemes that normally attach themselves to final salary type pension schemes. And while I'm talking about scheme types, it's often confusing terminology that is used in our industry about the different types of pension scheme, and in broad terms you can equate personal pensions with money purchase pensions and defined contribution pensions. They're all one and the same thing. I've got an example in a moment, and that is in contrast to a final salary pension, also called a defined benefit scheme. And the way I remember those is that a defined benefit pension is where the benefits are defined, so what gets paid at the end is sort of predetermined, and defined contribution is a pension that the size of which is defined by the contributions that are made along the way rather than years of service. And just to make things complicated, although there are those two major categories of pension scheme, do be aware of hybrid schemes, which are sometimes a complex blend of both of those schemes. And just to illustrate this, This is a statement which I'm using as part of the case study, and this is a defined benefit pension scheme quote. It's just one page of it, and the tip here, the hint is that defined benefit schemes have benefits which are linked to years and years of service and salary, and therefore you'll get the clue often in service dates and pensionable service dates as a guide that might be a final salary scheme. Also, they'll have more often than not, they'll have the lifetime pension stated in pounds, shillings, and pence. And in this instance, it was rather helpful, which isn't a feature of many statements, because here it does actually tell you it's a defined benefit pension scheme, but that is normally quite elusive. And on defined contribution schemes, it's quite simple, really, because where you've got a statement, one of your client statements that mentions the name of a fund, the number of units held, and what price they are, that should guide you towards the fact that this will be a defined contribution scheme. So hopefully that's just a bit of help. And for some further help, we were asked a few years ago actually to see if we could produce a one-page wonder on the difference between defined benefit schemes and defined contribution schemes. And this is one page of pensions made simple by its very nature of trying to simplify a complex area onto one page. It doesn't cover everything, but this is downloadable at our from our website. We have a page called Downloads for Solicitors, and I think one of my assistants will be dropping that web link, which you'll get. So there's this and other material you can download as a reference. Just before I sort of get into the hints and tips, we thought it'd be useful just to talk a little bit about investment markets and changing valuations, because we have had a rocky year, and some clients that certainly we've seen have been worried about investment markets and should they be doing anything with their pension or sharing their pension now, or should they be waiting? And just a quick market update, if you like, that here we've got a graph I'll talk through, and the blue line at the bottom is the FTSE, and this shows the FTSE performance since January 20 up until last week, and it shows that the FTSE still hasn't recovered from over a year ago. And of course that, unfortunately, in many ways is a benchmark by which lots of clients assess how the investment markets at large are doing. And of course, we'll all know that the FTSE index is a concentrated 100 stocks and shares, which isn't really representative of the investment world at large. And the other three funds, which are noted above here, are widely managed, diversely managed pension funds. Conveniently, I've extracted the performance of the BlueSKY 3 model portfolios, that three of the portfolios that we run, really just to illustrate that these are diversely managed funds, and if I'm honest, they will be showing a performance which is similar to many managed funds that your clients will be in if they're in defined contribution schemes. So the point I want to make here is that markets have recovered for your clients, so that there's no real reason for clients to defer. And of course, if we are helping with implementing a pension share, this is perhaps good reason to be implementing as quickly as possible, so a client makes sure that they're moving from one pension fund to another pretty quickly, so they aren't out the market for any length of time. So hopefully that puts the markets and valuations into some sort of context.
Mark, just before you go on, we've had a question from one of the attendees who's asked us, is the fund value usually similar or the same as the CTV?
Well, Jeremy, can we pause that? Because I would hope that the case study I'm going to work through will hopefully illustrate that. But if I go back a couple of slides, and of course the danger of doing this is I don't want to extend this beyond 40 minutes, but if it's a defined contribution scheme, the value of the fund that's shown there is the value of the fund. It's £93,000 because it's the number of units held times by the price. The value is the CE. The differences you get, which I will illustrate in a moment, is where you get defined benefit schemes where there are slight nuances to what the value is. But let me just get onto that. So I'm not going to elaborate on this slide. You'll get a copy of it, but where a financial planner can help, and these are the stages I'm going to talk through, is the initial inquiry. So where we can help around initial inquiry, where we can help and hints and tips around report generation, and then through to the implementations stage before you close your file. And I'm going to bang on about, discuss the case, unless it's a very plain vanilla case, it's always worthwhile discussing it with us before you start. And our involvement perhaps would start with you picking the phone up and discussing a case and us collating the initial detail to understand what's present, what the objectives are, and sense checking what you give us. And a couple of examples there are, we had a case a few months ago where a client had told us that they had a few schemes, one of which was an AVC, and an additional voluntary contribution scheme will invariably be attached to a final salary scheme, where the client hadn't listed the final salary scheme. So it immediately alerted to us that the client had disclosed an AVC scheme, and there must be a scheme to which it attached itself, which was the final salary scheme. So sometimes, and it wasn't, it was only because they had conveniently or otherwise forgotten that scheme, but it was something which we had dug out. Of course, sometimes it becomes evident when we look at the service periods to see. It's a bit like looking at a CV, if there's any periods of service missed, what's gone on. And we will also do a sense check on the values. And to give an idea of this, and hopefully this will answer the question that Jeremy just raised, is here we've got, this is a John Lewis pension statement from a client we dealt with, that we're still dealing with actually. But here we've got a total lifetime pension of nearly £85,000. The John Lewis scheme quoted nearly £900,000 as a value to that. Now, if I'm using a dangerous, rough and ready reckoner, that's about 10 times. So the CE was about 10 times the stated pension. That is at the lowest end of the spectrum I think any of us have seen for some time. 10 times the pension is a dreadful value. Just to put it in context, we see multiples from 10 times, which is this one, up to 70 times. And I would guess it averages around 25 to 35 times as a multiple. That's a very rough rule of thumb. Please don't openly quote that. But to put the value that John Lewis came up with in context, is the revenue would value this pension at 1.7 million for lifetime allowance purposes. I'm not going to elaborate on lifetime allowance at the moment, because if you want to know more about that, that's actually the subject of our next webinar in a couple of weeks' time. If you wanted to buy a pension of £85,000 on an index basis on the open market, the annuity cost would be about 3.2 million. So maybe this answers that question about, well, what is the value? Of course, the main point here is the value that John Lewis have told us. it isn't any other figure. Even if you ask us what's the true value of this scheme, it doesn't matter. We do get asked that a lot of times, and actually, in our opinion, that's of academic interest. The true cost of the pension is of no real value, other than perhaps annoying us that John Lewis have quoted such a low price. Now, we did dig a bit deeper. There are reasons why that is a low cash equivalent value that John Lewis have quoted, but they are notorious, or were notorious, for offering low CEs. And there's a bit of a twist to this tale at the end, if you stick with us to the end. The first thing we do when we triage a case, the first thing we do when you give us information is to triage the case. And I just want to work through this, as you've seen the data here for the John Lewis scheme. What we've also got, or having triaged a case, so looked at the pensions that are present, it becomes very evident that the direction of the pension share is going to be from the wife to the husband. Sometimes it's much more marginal than that, so not so easy to determine, but clearly here there's a big differential. So we know the direction of travel, which is why here we've set up a receiving pension pot for the husband, because the John Lewis scheme will only transfer externally, so they'll transfer a lump of money from their scheme to a scheme that the husband sets up. What is of note here is that the value that the husband's got a teacher's pension scheme, that's the TPS, teacher's pension scheme, it's a final salary scheme. Now, it's quoted 21,000 as a value. My point I want to make here is that because the direction of travel is going from the wife to the husband, we don't really need to know what the CE is. And triaging a case helps us identify that, so we don't have to wait up to 3 months to get that figure from the teacher's pension scheme. The only figure we want is what benefits are payable, and in most cases, in many cases, your client will be able to get their pension benefits from their own portal. And so that's my next point, is that you can help speed the case along by asking clients to provide data, so provide web prints from their own client, from their own pension portals, that invariably they will be able to access. I think the other point I wanted to make here on collation of data, always include the state pension. And some of you will have seen this before, where, of course, if you don't include the state pension, you may have created equality of income in the early years, but come state pension age, you may you might now have differing pension incomes for what is potentially a much longer period of time than from age 60 to 67. And therefore, if you look here, then you'll see that when you do create equality of income at state retirement age, there might be a differential here, which we would quantify in our reports, but you've actually achieved a long-term objective of creating equality of pension income in the long term. Also, as part of the initial inquiry, and this is where it gets a little bit technical, so stick with this, is we will discuss any initial financial planning thoughts that we have which might benefit both sides, that there are actions that could be taken before you even consider pension sharing. And those 2 points can often be, given a scenario where one party might be short of money, we can, before pension sharing starts, consider drawing money out of a pension if they're over age 55 to perhaps help fund their legal fees or live. And of course, it might also be, if there's no pensions they can draw money from, it might be arranging specialist finance, which I know many of you know of, the specialist finance houses that can help fund divorce proceedings. The second thing that we might discuss with you, if we were invited to and thought it might be worth mentioning, is whether there was capacity and benefit in one or other member making pension contributions before the pensions were shared. And just to elaborate on this is a slide I'm not going to spend a lot of time on, but if you wanted to access money from a pension, if your clients were over 55, they might be able to do it from via what is called flexible drawdown, but that would need financial planning advice. The other two pieces of legislation are small pot legislation, where if the pension fund size is under 10,000, they can access the fund as cash, or trivial commutation, which is something I'm going to elaborate on in this case study. So both of these sets of legislation are designed to allow clients to have access to small pots of pension money. And if I go to this as an example, this is back to this triaging a case. You'll recall that this teacher's pension scheme for the husband was valued at 21,000. That's a small pot of money, and the revenue rule is that if the benefits times by 20 is under 30,000, then you are able to commute that pension for a lump sum. In other words, the husband would give up rights under the teacher's pension scheme in exchange for, in this case, £21,000. That's a very, this is, I'm probably missing out a few steps in the process here, but to all intents and purposes, the husband could access some money as a lump sum, which might help his own expenses while he's divorcing. If I now move on to how does this pension share work out? So given the facts of the case that we've discussed before, how would a pension share work out? And in this instance, it was necessary to pass 77% of the John Lewis pension scheme to the husband, along with 100% of the Zurich scheme, which was a small one, only worth £25,000. But what that did is it produced equal incomes. Now, one point here, and this is an extreme example, so they're not as big a horror shows as this one is, but because the John Lewis scheme offered such poor value for money, because certainly in those days, I think John Lewis wanted to protect its pension members and not support its members who chose to leave the scheme, so it offered poor value. What we found, and we would call this a destruction in value, is before this couple got divorced, or before a pension share was implemented, they had joint pensions of over £104,000. Post share, their joint pensions go down to £59,000. So quite a loss in value. So loss in value because you've got to share so much of the John Lewis scheme. You've got to take so much of that scheme in order to give the husband a big enough fund to produce an income. And so that's pre. If we then look at making a pension contribution, and often we will recommend making pension contributions to use the tax benefits which are available to clients, because this could improve the overall value of the pension sharing arrangement for both people. And in this scenario, the wife was a high rate taxpayer. As we've mentioned, the John Lewis scheme offers a really poor value for money. So if you like, what you're trying to do with a pension contribution is to stop so much of the John Lewis scheme having to be shared, because every pound you take out of it affects the income massively. We knew the client's objectives because they were close to retirement. They wanted to get the best retirement income they could, and they did also have £500,000 of cash available, which was going to be shared. But before we did that, before we shared the pensions, we suggested that they considered paying £100,000 into the wife's Zurich pension scheme. That would give tax relief to the wife of 38%, so a nice tax saving there. And if we look at how those figures worked out, what you'll see here is that the Zurich scheme was 25,000. It's now 125,000 pounds, and we're going to share that to the husband. We're going to give all that to the husband. And so what we've done is because we've added that money to the Zurich scheme, the necessity for the John Lewis to share has gone from 77 to 72%, and the destruction in value is less. You'll see that the pension has now, to equalise pensions, has now gone up to £33,000. And if I summarise that, and look, I appreciate that this is quite a whiz through of this case study, but where we were before the pension share was 77% and quite a big destruction of value, and afterwards we only needed a 72% share of the John Lewis scheme, and you'll see the destruction of value, as I put it, has reduced, and the net outcome here, and this is not this, there are cases we've done which look much better, even better than this, but in this instance, what we've done is we've taken £100,000 of cash to provide £7,000 of income. Now, if you say to anyone who's at retirement or heading to retirement, I can give you a guaranteed return of 7% on your money, that's pretty good. That's a pretty good rate of return, and in this instance, this was part of the solution that we came up with for the client to preserve the value of the John Lewis pension scheme. So my final point at the initial inquiry stage is just talking a bit about ring fencing and trying to aid the understanding of why ring fencing is not popular for several reasons. But let's just I'll try and explain what I mean by this. And here we've got a client's income profile. It's not untypical that someone in their early years will have a gently increasing income. They get into their stride and start getting promotion, their salary increments, their salary increases, and perhaps plateaus in later life. So this client, 20 years, earning £100,000. His pension, he's getting divorced, his pension is valued based on his salary at the point in time he's getting divorced. So this is a final salary pension. He's done 20 years. That's when his pension is going to be valued. Now, what the husband then came back with and said, "Oh yeah, but I've only been married 14 years. I want the pension that I accrued from 0 to 6 years not included in my pension share." The problem is that at this point in time, the husband had no idea what pension he had accrued and couldn't remember what his salary was, which is the situation which I think is often the case when people when you're getting married and walking up the aisle, I don't think you think I must get my pension statement before much time passes. So, however, I'm going to pretend that we knew that the client didn't know, but we knew his salary at that time was £20,000. So, of course, his pension benefits that he would have accrued at year 6 will be based on his salary of £20,000. But we didn't know that, and it's very difficult to get that information, almost impossible. So the only way we can approach that when we do our calculations is to adopt something which you will have heard probably if you've read pension sharing reports, and that is the straight line method. The straight line method assumes that this individual will build his pension benefits on a straight line basis. So hopefully you can begin to see the errors or the problems in doing this, because we're adopting a straight line basis, we will have assessed that at the 6-year point, he will have a salary which is not £20,000 but £40,000, and therefore we will have assumed that at the point of marriage his pension was twice as big as it really was. So that's of detriment to the wife in this case. So you can see that a straight line method is quite a crude tool of working out pension benefits. If you've read the PAG report, you'll also note that the Pension Advisory Group doesn't support ring fencing in most cases, because it believes that most cases are based on needs, and in needs cases the court has access to any asset necessary to make ends meet, and in general the PAG doesn't therefore support this ring fencing. It's also very difficult to get the correct data, particularly from final salary DB defined benefit schemes. One possible solution is well, could we ask our clients, do they keep pension statements from all those years ago? Or what's maybe more likely is they might recall or have evidence of what their salary was at the date of marriage. But I think you'll appreciate that the straight line method is likely to be inaccurate, and that's talking about final salary pensions or DB pensions. If you think about DC funds, which are pension pots of money, we can also have the same issue with these funds, where on initial discussion we're told it's just a prudential pension with 200,000 in it. But if you want to apply ring fencing to that and we dig under the bonnet, we might find that there's transfers in from previous year's service that a member has had with another employer that they've consolidated into one scheme. And it does create a complete can of worms to try and unpick transfers and transfer dates and what the various funds have grown to. So you can see that that can turn into a bit of a monster. I want to talk a couple of points on report generation and just talk a little bit about annuities and annuity purchases, because this is a question we get asked a bit. In this instance, going back to this case study, you'll see that the husband ended up with £840,000 worth of pension credit. And the methodology used in all reports, and it's not just BlueSKY reports, it's the actuarial industry as well, will always apply an annuity rate, an annuity purchase to come up with the income that £840,000 would provide. So annuity rates have been applied there. Of course, we are fully aware that the annuity rates have tumbled over the last couple of decades, and still in recent times have fallen further. And the problem there, and something just to be aware of, is that as annuity rates fall, it does mean you need a larger fund to create the same level of income. That's the way it is, and it is inappropriate to use any other method for some quite technical reasons which we could get into, but it's inappropriate to use anything else other than annuity rates. And what's also worth noting is that although any pension sharing report will use annuity rates, it isn't advice to do so. And once you've come to an agreement on the pension share, it is important that your client should seek advice to say, well, I've now got this pension share. What do I do with it? Should I buy an annuity? Could I buy an annuity with some of it, all of it, or what else can I do? And the other thing I want to point out is that if your client has ill health, it can increase annuity rates. And what we're finding now is that more and more annuities are underwritten. So invariably, we will get we will ensure that we will underwrite or get the annuity quotes underwritten properly. You need to think of the consequences, because sometimes people argue for something that actually might go against them. And to use that as an illustration, this is the same slide that I brought up earlier. And this is where £840,000 bought an annuity rate and gave 23,600. In this instance, the husband had cancer, had bowel cancer, and thus did qualify for an impaired annuity rate, and gave rise to a improved rate, and you'll see it went from 23,000, 23,500 to 26, and now we've created unequal incomes because the husband has got that impaired annuity rate. So what that means is that the share going to the husband will now have to decrease to rebalance the books. So it's interesting that sometimes we get a lawyer or mediator acting, or a lawyer acting for someone who's in ill health, and wanting to make the point that he's in poor health and that should be considered. Well, if it is considered, you just need to be aware that it probably would reduce the pension share that that individual would get. I'm now on the home run. For those of you, thank you, who stuck with us so far, and this is moving on to implementation. And again, the PAG report, I would commend that people should read it, because it does talk about closing the case and the fact that you shouldn't close your file until the case has been implemented. And it does document all sorts of reasons and all sorts of dangers that if you have reached agreements with a client, done a decree absolute pension sharing annex, and close the file, the job isn't done yet because the case hasn't, the implementation hasn't been concluded. Particularly with large cases, one has to take a lot of care in making sure that the scheme is implemented correctly and quickly. And that's assistance that BlueSKY can provide. I've got a slide I'm going to go on to in a moment on dating the pension sharing annex and decree absolute, and a little bit on cash flow modeling. But just for the just to ensure we're trying to stick to time, just want to talk about timing of the pension sharing order and dating it, and remember that the pension sharing annex can't take effect until 28 days after the date of the order or the date of the decree absolute, whichever is the later. So in our world, in my simple language, a pension sharing annex has a 28-day cooling off period, and if the decree absolute is dated, let's say at the same time as the pension sharing annex, you've got a situation where the pension sharing annex could still fall away if it was contested, but because you've got a decree absolute sealed, the spouse is no longer a spouse, and therefore not entitled to spouse's benefits. And in the 20 years that we've been doing these pension sharing work, we've had 2 cases where there has been a death in the period between decree absolute and or the pension sharing annex and decree absolute, and there have been a couple of quite major problems created where the dating was wrong. And if I put that into picture forms, what you shouldn't be doing is sealing the getting the pension sharing annex sealed at the same time as a decree absolute. The right way of doing it is to apply and get your pension sharing annex and then wait 28 days before the decree absolute is sealed. And just one final twist, going back to my case study. This is a case study which we started. It was a real case which we started in 2017, and that was the value, £889,000. For various reasons, the husband dragged his heels on implementation, and what became evident was that John Lewis, under probably quite a lot of pressure, had decided to apply more reasonable valuations to their schemes, and the revised CE went up to 2.2 million. So there's all sorts of issues around this. This is a topic on its own as to why it happened, but in brief, valuation changes for DB schemes are often well, largely based or influenced by gilt yields. Gilt yields have tumbled and continue to fall. So a DB pension, a final salary pension, will be affected by changing gilt rates, as this scheme has. Also, investment assumptions. So if the scheme thinks that the future for investment returns is reduced, or indeed has higher scheme experiences of mortality, then it will revalue, or it can change the method that it values schemes. I think also with the John Lewis scheme, not only had gilt rates fallen, I think that John Lewis had been under quite a lot of pressure to make its values more realistic in line with the market, and I suspect there was some scheme discretion there as well. As we all know, John Lewis were highly acclaimed in the past for looking after its members, and therefore wanting to protect its members rather than leaving members. I think the scheme is slightly in a different position now, that retail looks under some pressure, and it might now be in a situation where it's trying to encourage members to leave its scheme. So once you've, I've mentioned this before, I want to mention this again, that throughout this process, one of our hints or tips is that cash flow modeling can offer enormous value to help guide your client either through the process or at the end of the process, to show them what their financial future might look like. And if I gave an example of maybe during this initial discussion that we have with you or your clients about, well, this is an offer the other side have made, should I accept it? We can test an offer, for example, to say, well, this is what's been offered, and what you'll see here is if we model that through, it shows that you're going to run out of money in your late 70s. So we need to scratch our heads to either go back and renegotiate a higher offer, or maybe set your clients' expectations about what their expenditures are, or when they can stop work, or all sorts of matters. So cash flow modeling is enormously valuable, and we can. This is a snapshot of our pension sharing reports. We will often put in graphs to show what our pension sharing recommendations look like graphically, but also, if invited to, and if we feel it's helpful to, we will also put in cash flow modeling into our pension sharing reports, only if asked. Otherwise, we'll produce a plain vanilla pension sharing reports, but that's what we'll do. Also, it's worth mentioning, in our pension sharing reports, we will also provide all the consolidated data you need for your pension sharing annex at the back of our pension sharing report. So if you agree with what's the share that we're recommending, you can lift this information onto your pension sharing annex, and know that you've got the right company name, address, and scheme number. Thanks for sticking with us. I think we're slightly over time. This is a final, this is just a reminder of all the stuff we do. And look, that's the end, but let us know, please do let us know what you think. Rob or Jeremy will have dropped this link into the into your chat box. So if you wouldn't mind clicking that, you can go through, answer the survey. That would be marvelous. A reminder that the next webinar is on the 7th of April, and it's on pension sharing and the lifetime allowance, and that starts at 11 o'clock. And the other thing, I think Jeremy is working on newsletters. Jeremy, can you, what was there to say about newsletters?
Yeah, just signposting all of our attendees today to our website. I've pasted the links into the chat function on Zoom. There's some really good documents and thought pieces there from BlueSKY, and there's also the ability for those of you that aren't signed up to our newsletter to do so by just giving us your your name and your email address. So do have a look at that part of the website. I think you'll find that there's lots of really interesting stuff there.
Great. Well, look, thanks ever so much for attending. We're going to hang on for a bit to answer any questions live, if that's appropriate. Rob or Jeremy will perhaps we'll see what questions come in. If the questions die out, we'll obviously end the webinar. But thank you very much for your attendance. So, Rob or Jeremy, have we got anything that's worthy of note?
Well, as it happens on this occasion, I think we've been able to address most of the questions as we've been going along. Really pleased to see that we had 95, I think was the highest number today, so that's pretty good. Very pleased with that, but no particular questions that I wanted to bring up. Jeremy, I don't know if you've got anything as yourself.
Nothing that I can see.
There you go. There you go. Well, look, that's fine then. Shall we log off? Last chance for anyone to say anything. But
that's cool. I'll tell you what, leave it open for maybe 2 or 3 minutes. I think everybody's sort of wandering their way out.
We did just have one question, Mark, about whether getting a pension sharing report on a firefighter's pension scheme is the usual approach, and I know that public sector pension schemes in general can be pretty tricky. So perhaps you'd just like to add some comment to that.
I think a lot of the attendees will know that we really, to limit the volume of work we deal with, we refer on public sector schemes to actuaries, but a lot of the public sector uniformed services pension schemes are particularly complicated, and absolutely is a flag that a pension sharing report should be produced. The pension benefits will be based on the level, the rank achieved, and certainly with the firefighters and police and army, they have early retirement dates where other benefits become payable at early retirement. So they are particularly complicated, and out of all the schemes, where there's anything of any substance, I would certainly say a pension sharing report should be applied for.
There was actually a second question on the question and answer, which I answered directly because I don't think the question was entirely clear. I made an assumption on it, which was how do unfunded annuity pension schemes work? Now, I've interpreted an unfunded annuity pension scheme to be that of the kind of thing you might see with some of the very largest of employers, the likes of Mars, who would have a main final salary scheme, and then for their executives, almost like an extra special scheme strapped onto the side, which can cause all manner of fears, I guess, for the pension on divorce expert, because they are largely funded by the employer, just like they would fund payroll. So a bit difficult to know exactly what the questioner was asking in that particular instance, but so I answered that one directly.
Yeah.
But I think it could be an unfunded pension scheme that they might be referring to.
Yeah.
I think Catherine's got a question here. Let me just have a quick read. Oh, okay. Catherine has said, where the court has ordered a pension sharing report and you have been identified as the single jointly instructed expert, but one party objects to signing the letter of instruction, should we just send a letter to you to make a start? The party has already filled in all their details and pensions, but just delaying matters. Well, I can think of one particular case where I had a letter of instruction, which purported to be from both sets of solicitors. We invested a large amount of time preparing that report, and the report went off to both sets of solicitors, and the second solicitor said, "Don't know what that's about. I never signed that letter of instruction." But thanks very much for providing us with the information. How about you answer all of these questions instead? So that's always a worry, Catherine, where we don't have agreement from both sides. I don't know if Mark or Jeremy have got anything else to add to that one, but I still have nightmares about that case, particularly because ultimately it ended up on a well-known barrister's door, which anyway, enough said about that case.
I think Rob's right. We've got to be really careful when we're instructed that we don't invest a lot of money going down an avenue that turns out to be the wrong one. I think we would take each case on its merits, and if we know a lot of our instructing lawyers and mediators quite well enough, whether we think, yeah, we can start this one because we know it will come, all the pieces of paper will come in the end. So we're pragmatic about it. But Rob's case, we've had a few. Sometimes you try and be helpful and you fall on your own sword. So we are mindful of that as well.
Well, it's funny because Catherine goes on to say the other party is acting as a litigant in person, but not paying for their share now. Which one of the three of us is going to dive in with a response on that one instantly? I'll let you have a play on that one, Mark.
Well, look, I don't think we're out of line with probably lawyers and mediators who would have some concern about litigants in person. In our experience, they it's like someone who tries to do financial advice themselves. A little bit of knowledge is dangerous. They're a bit of a nuisance. They often don't pay if they don't like the answer.
Mm-hmm.
They come. Well, I'm teaching everyone to suck eggs. We don't really like them. We do ask them to pay up front, which is not normally the case with our pension sharing reports, and we only insist on payment up front because that's the only people that we've had problems from regarding payment. They think they might not. They think they don't have to pay because they didn't like the answer, which is bizarre. Right.
Good.
Are we good?
Yeah, I think we're out of questions.
Well, thanks everyone for coming. Those who are left, and hopefully see you next time.
Thanks, Mark.
Thanks, Mark.